Today, we're going to pull back the curtain on the hidden playbook that turns a tiny startup in a garage into a global giant. We're talking about the powerful financial engine that can totally reshape companies from the inside out.
I mean, think about it for a second. How does an idea that was literally sketched on a napkin become the next big thing? It's a journey almost every major company has taken. But here's the thing, it almost never happens on its own.
And it's not just about the brand new companies. What happens when a household name, a brand you love, starts to stumble? How do they get a second chance to reinvent themselves and come back even stronger?
Well, in so many of these stories, the answer is a powerful and honestly an often misunderstood force: private equity. So let's get into how it all actually works.
Okay, so at its absolute core, private equity, or PE, is all about investing in companies that aren't on the public stock market. This lets them get to work without all the pressure of daily stock prices and quarterly reports. And the goal? Well, it's really singular. Make the company more valuable over a few years and then sell that investment for a nice profit.
So, how exactly do they pull this off? Well, PE isn't just one single thing. It's a whole spectrum of strategies, and you can define them all by just two key variables. First, what stage is the company in? Is it a tiny little startup or a big, mature company? And second, how much control does the PE firm take? Are they just a guide in the passenger seat, or are they grabbing the steering wheel? Every single strategy we're going to cover is really just a different mix of those two things.
All right, let's start at the very beginning of a company's life. This is the exciting world of venture capital.
Venture capital, you've heard it called VC, is all about making a big bet on the future. These firms back brand new companies that they think have massive growth potential, and I mean massive. Often, these companies aren't even making any money yet. And because they're so new and risky, they can't get loans, so the investment is pure equity. It's a huge bet on an idea, and just as importantly, on the team behind it.
Now, here's a really crucial detail. VCs almost always take a minority stake. They are not trying to buy the whole company. And that's by design. It keeps the original founders in control, motivated, and in the driver's seat, while the VC firm provides the cash and, of course, that valuable strategic guidance.
This captures the entire VC philosophy. It is a numbers game, a portfolio game. They actually expect most of their investments to fail. The whole model is built on finding just one or two of those spectacular home run successes that will pay for all the losses and then some.
So what happens when a startup isn't really a startup anymore? But it's not quite a giant either? It's got a proven product, it's got customers, but it needs some serious cash to really scale up. Well, that is the sweet spot for growth equity.
You can think of growth equity as the bridge between that early, super risky VC stage and full maturity. These are companies with a product that works and a customer base that's growing fast. The money they get isn't just to survive, it's to dominate. It's capital to fund a huge expansion, go into new countries, or maybe even buy out a smaller competitor. And just like VCs, growth equity investors usually take a minority stake. This means what they bring to the table has to be more than just a big check. They bring in their strategic expertise and, just as importantly, a massive network of contacts that can help that company fast-track its way to the top.
Okay, now we get to the most famous, and sometimes, let's be honest, infamous strategy in the whole private equity world, the leveraged buyout, or LBO. This is for the big, established players.
So here, the playbook completely flips. LBOs are all about getting control, buying a majority stake, or sometimes the entire company. The targets here are not risky, high-growth startups. No way. They're mature, stable businesses. Because the single most important ingredient for an LBO is predictable, reliable cash flow.
And here it is, the key mechanism that gives it its name: leverage. A huge chunk of the purchase price is funded with borrowed money, with debt, which is secured by the assets of the very company they're buying.
So you might be asking, why on earth take on all this debt? Well, the goal is to improve operations, increase efficiency, and pay down the debt over time. The PE firm uses its control to streamline the business, cut costs, and basically use the company's own cash flow to pay for its own purchase. The whole bet is that they can unlock value that the old management team couldn't.
But what happens when a company isn't doing well? When it's really struggling, maybe even facing bankruptcy? This brings us to our final strategy, the high-stakes world of distressed investing.
This is basically the emergency room of the corporate world.
investors swoop in when a company is in deep financial trouble. A really common move is to buy up the company's debt for just pennies on the dollar. Doing that can give them a ton of leverage or even outright control during a bankruptcy or a major restructuring. It's a super complex game that requires some serious legal and operational expertise.
So a lot like venture capital, this is a high-risk, high-reward game. It's just played at the complete opposite end of a company's life. If you fail, you could lose everything. But if the firm can pull off a successful turnaround, the returns can be absolutely spectacular. Okay, so we've traveled all the way from the garage startup to the corporate giant and even stopped by the struggling brand. Let's put this all together on one simple map.
This map really brings it all into focus. You can see the pattern, right? As you move down from venture capital to LBOs, the company gets more mature, the stake size goes from minority to controlling, and the use of debt becomes way more central to the whole strategy. And the goal shifts too, from just betting on pure explosive growth to scaling what already works to finally optimizing for maximum efficiency. And distressed investing? Well, it kind of sits apart. It's that specialized play for when things go really wrong. It's a full toolkit for every single stage of a company's life.
So it's clear that private equity is an incredibly powerful tool for reshaping our corporate landscape. It drives both creation and transformation. But that leaves us with a bigger question to think about. As these firms unlock all this value and chase their profits, who is ultimately benefiting the most from these high-stakes makeovers?